But bringing that back, where we started with all this is diversification. So when you diversify, what you're doing is you're taking the risk, you're taking the element of danger or perception of taking the risk out of the situation, because the false pretense is that if you diversify your portfolio or diversify your holdings, what you're doing is you're spreading the risk. Nothing will all fall at once. So you're taking the element of risk out to the best degree as you can. And in reality, maybe once upon a time that was the case. But one of the things that have happened over the course of the globalization of the planet is the world has become more connected. So things like telephone networks, internet cables, we've now got satellites through Starlink that are connecting the world up. We've got Wi-Fi that's available in planes. We're using smart devices and apps to transfer, banking information, details and payments at our fingertips. We're even paying with our phone now. So these are things that 10, 15 years ago would have been unheard of, such as the rate of technology. So within that, it's a fast-moving environment. And in that fast-moving environment, what we realise is that there's a interconnectedness that wasn't there before. So the idea of diversifying to spread the risk, is that the same as it once was, or is it as true as it once was? Because when it was true, and this idea was sort of thrown around as the way to mitigate your risk, that was in a world that was much less connected than it is now. And when you look at it, the connectedness is a big element of, is that diversification strategy a good play? And when you look at the information and data, you realise that it isn't, because what you have is, with that interconnectedness, you have everything's more reliant on supply chains and the connection of different asset classes that are now have a degree of connectedness that they never had before. So the whole premise of diversification is that if one thing fails, it isn't connected to the other 9 things that you have that in. And with this new connectedness that we have in the world, that just isn't the case. We have much higher connectedness, which makes things much more influenced, which means that one thing that failed before that didn't affect the other 9, there is now a domino effect that takes place. If you look back at the information that happened in the Great Financial Crisis, you'll see that that was the case. It's something that happened in the subprime mortgage market in America, caused a topple effect that caused a stock market crash, that caused contagion through industry, supply chains, the bond market, the credit market, the stock market, mortgage market, and the currency markets. So you can see the connectedness is now so strong that the idea of diversification isn't what it once used to be. And what I would say to you is that if you're out there as an investor and you are new, learning, or maybe you are pretty developed, is one thing I would urge you to do is not to be caught up in the trap that if you diversify, that you will just be out of the woods in terms of your risk, because it just isn't the case anymore. And there is ways of hedging your risk, which is different. Now, to explain why hedging your risk differs from diversification. So if you hedge your risk, what you can do is you can take a particular position in a particular item that you think will do well, and you can take the best performer in that group and you can think they will do amazingly. So the great example that I heard years ago from the guys at the ITPM was, say for instance, you were back in the UK when there was a whole boom of supermarkets. Say for instance, you wanted to invest in supermarkets and you wanted to hedge your risk in case there was, a crash or a shock or something happened to the supermarkets, and there was a surprise. What you would do is you would take a position in the best one. So the best one at the time was Tesco. It was the main player. You could bet that they were going to do well. And one of the least performing ones was Sainsbury's. So you might take a position thinking that they aren't going to do well, and you think Tesco will. What you're doing is you're hedging your bet. So you are taking your bet on the whole sector, which is the supermarkets, and you are going long or buying an idea on the Tesco side, which is the best performer, but you're covering off, you're betting that Sainsbury's won't do well, and that means that if there is a market shock, Sainsbury's will go down, which means you'll get paid for that because you've thought that they would underperform by shorting them. And then that would cover your loss that you might make from Tesco falling. And one of the things that you find that hedge fund guys do is they monitor the best performer is likely to go up higher than the worst performer. So that creates the gap or the performance. But when things go down, they tend to go down quite uniformly. So if there's a drop, they tend to drop and everything drops at a similar rate. And that's the idea of hedging. And you can do that on different sectors. You can do that in different, you can do that in currencies and various strategies. So hedging is a very specific way of measuring if it does go against me, then what's the best way to play that? And that's very different from diversification, because diversification is, right, I'm just going to spread it out and hope for the best. So there's a lot more analysis and thought that goes into hedging your risk than diversifying your risk. And this is where a lot of, financial advisors and a lot of, people that are well-meaning in terms of their advice are looking at the past when the world wasn't as connected, thinking, hey, diversifying is a great way of managing your risk. What you want to look at is the expert guys that are trading the big bucks and how they look at it and the differences between them, because hedging a risk and diversifying a risk are worlds apart. And the best performing asset managers are proof of that, because they are handling tens, if not hundreds of billions of pounds or dollars, and they're taking huge positions where they're using these strategies to great effect to cover the risk that they're planning on taking. But what they do is they become an expert in their field first. So they become an expert at what they do on one particular thing. And then once they've learned that craft, they can then lay that out to all the other different component parts.